Thank you for checking out this week's Municipal Market Update. I am hosting this with Glenn McGowan. Glenn McGowan is a Director and Senior Municipal Underwriter with RBC Capital Markets. And we have kept our similar slides, but we're going to walk through this together. It is the week of April 19th, 2021. My name is Adam Bauer. I serve as CEO and President of Fieldman Rolapp Associates. Fieldman Rolapp Associates is a municipal advisor to government. On our first slide, we've looked at the MMD and the range of interest rates that have taken place since 2005 for maturities 1 through 30. The gray bars represent the range of interest rates for each one of those maturities, and the red line represents where the MMD was on 4/16/2021. So Glenn, maybe we could pause for a moment and have you talk a bit about what this represents and where we are compared to historical standards with interest rates.
Absolutely, Adam, and thank you for having me. I think this graph does a very nice job of representing in a very effective manner what the range has been and where interest rates are. We were, as an asset class, I think we really had the benefit over the last year of achieving historic all-time lows across the yield curve. And in the municipal market, really it was August 7th of 2020 where we hit those all-time lows in the 5-year, 10-year, and 30-year parts of the yield curve in those core benchmark maturities. Obviously, we've come off those lows a little bit, as has the Treasury market, but we've come off those lows at a slower pace than Treasuries. In other words, the rise to slightly higher interest rates on the MMD tax-exempt side has been a slower rise than it's been on the Treasury side of things. And when you see that range, it really depicts the idea that although rates are no longer at the historic lows, they remain historically low. So this is a great time for the issuer base to be in the marketplace because, again, interest rates have rarely, if ever, been lower. You really would have had to capture the marketplace that first week of August 2020 to be at the all-time lows, and we're really not far from there. Case in point, as of the end of last week, the 10-year MMD was only about 35 basis points away from its historic low. 30-year MMD was only 28 basis points away from its historic low. So I think when you really see those bars that you're showing there on the first slide and what the range of potential interest rate outcomes has been from a more historical perspective, it really makes that point quite nicely.
And Glenn, another thing that this chart I think jumps out at me is if you look at the 1, 2, and 3-year maturities, we are at the absolute low with those bar charts, but then we lift off that a bit. So I think, would you say that we are on the short end of the curve, we are still at those all-time lows, although for most of the maturities where issuers are issuing, we have lifted off just a bit?
Yeah, that's true. Really inside of 5 years, the first couple of years of the yield curve, 2-3 years of the yield curve remain at the all-time lows. And I think at the end of the day, the dynamic driving that is there are still investors willing to park cash on the very front end of the yield curve for safety and liquidity purposes. And I think the fact that we have had such significant inflows and sometimes when an investor may not like interest rates further out the curve, the ability to stay short and stay safe is an option that they consider. And so I do think that that's part of the reason why we've seen the front end relatively anchored, even though rates have drifted modestly in other parts of the curve.
Great, thank you. And on our next slide, I've talked with the viewers of this a little bit about this, the flatness of the yield curve throughout most of 2020. And we have seen a bit of a steepening to this. Can you just talk to a bit about what we've seen over some of the periods that we have listed here?
Sure. So the steepening of the yield curve really started to take shape in the third and fourth quarter of last year. And really it was driven by what was happening in the Treasury market. Once stimulus measures had been passed by the federal government, the need to finance those with Treasury auctions and the growth in inflation expectations driven by those stimulus efforts, those were all catalysts for higher interest rates. We also saw not only did those Treasury auctions grow, we also saw the introduction of some new Treasury securities, namely the 20-year. So we started to see those Treasury auctions grow, particularly on the long end of the yield curve. We started to see the Treasury selling bonds in new maturities. We started to see expectations of higher growth, and with that, expectations of inflation. And all of those things have caused the yield curve to steepen out a little bit versus where it would have been a year or even 5 years ago. So we are still looking at rates that, as we just talked about, are pretty close to the all-time lows, but certainly with a slightly steeper yield curve than what we've become accustomed to. You see the steepness in the Treasury curve a little bit more significantly than you do in the MMD curve.
And what we've focused on this next slide is demand for bonds and just inflows versus outflows. But for that period of time when there was a sell everything rally, munis were within that, and you see that in that March timeframe.
Right.
What have you seen with some of the inflows in the funds, and what does that mean to the job that we undertake?
It's really amazing when you look at that chart of those fund flows and you see that negative bar, that red bar, that represents actually the largest all-time outflow of our marketplace. And around the same time that was happening, you saw that in other markets as well. The corporate bond market also had historic outflows around that same time period. And it's amazing to think that just several weeks later, we were back to inflows. And if you were to fast forward and look at the inflows that we've seen this year alone, the monthly reporting funds, if you combine the monthly and the weekly reporting funds, you get a cumulative inflow to the tune of about 38 billion, which is pretty significant. So the inflows have been consistent. They've been driving demand for bonds. And I think that, as we consider what may come out of Washington in the months ahead with additional stimulus and the potential for higher taxes, that's a cycle that's that's a fact pattern, I should say, that favors tax-exempt municipal bonds. The higher taxes go, the more likely you are to see inflows into tax-exempt bond funds and other products that are not necessarily tracked by this. The SMAs, for example, the professional retail accounts, don't have to report their holdings. And so we don't really have fund flow data that corresponds to the SMA side of the business. But generally speaking, we look at the mutual fund flows and we view that as a proxy for half the market. And we assume that what's happening with professional retail accounts and the fund flows that they're seeing, that mirrors what the mutual fund flows are looking like. And so the significant inflows that we're seeing are evident not only with the mutual funds, which we have actual data for, but also with the SMAs. And that flow of demand out of those investors has been resilient and very, very strong for the majority of this year. So I think that continues in a world where we're likely to have higher taxes to pay for some of the stimulus. And in general, our market has been a beneficiary of concerns of higher taxes.
Great. Great points there. On our next slide, what we're showing here is the supply of municipal bonds. So we've talked a bit about the demand. Before the calendar turned over into 2021, there were a lot of firms that had projected that we'd have a greater amount of issuances in 2021 than we did 2020. To some degree, that might have been disrupted by the upward trend in interest rates. But Glenn, what are you seeing for the balance of the year? Do you think we will continue to have the similar amount of volume, or will we have something that might rival a 2021 type level of issuance?
Well, with the caveat that I'm a much better Monday morning quarterback than I am a forecaster, I will say that, we are expecting to have a lighter pace of overall issuance this year versus last year. It was amazing that we had a several-week period where the municipal bond market was really closed down for all intents and purposes in March and April of last year. And then it started to reopen in May, and we actually ended the year with a total supply of negotiated and competitive debt of around 460 billion. So publicly issued debt, not including private placements, about 460 billion. That was up about 12% from 2019. And, a significant chunk of that was driven by taxable refunding activity. We don't see the pace of that taxable refunding activity sustaining itself. And so our forecast for this year is for about 425 billion of total issuance negotiated and competitive versus about 460 last year. I will say that if you look at the numbers year over year, right now we're up about 20% on a year over year basis. But that number is a little bit misleading in the sense that, in April of 2020, issuance had pretty much ground to a halt. And so we're catching up and outpacing supply because, March and April of last year were very light months. But I think as we make our way further into the year, we're probably going to be on pace for something in the camp of what we're forecasting. Right now, we're actually annualizing to just around 425 billion. So I think that number is a pretty good number for right now. But I think a lot of it will also depend on, whether or not tax-exempt advance refundings come back or Build America bonds come back, because those are the two big outliers that could drive supply, whether it's for refunding or for new money purposes. So we have to definitely keep an eye on the legislative process in DC over the next several weeks and months.
Great, thank you. And on this chart, we are comparing the 10-year US Treasury to the 10-year MMD. And I've spent some time talking about when investors are concerned, oftentimes they will agree to pay more taxes to get liquidity and not necessarily get the yield. By highest yield, when you take into consideration the tax consequences. And so here you're seeing this this change between the U.S. Treasury and the AAA MMD over time. Really, Glenn, anything you want to add to this about how this relationship has changed over the last year?
Yeah, absolutely. So really what you're seeing as the graph of the 10-year Treasury diverges from the graph of the 10-year MMD, another way to think about that is ratios and performance. So in other words, muni rates hung in there better than Treasury rates did. And the reason for that is outperformance due to a few different things. The Treasury market was certainly reacting to expectations of growth, and which we're starting to see. The economic data has been very positive, and we're seeing inflationary pressures play out. Last week, CPI, the week before that, PPI. We see it in certain commodity markets, whether you look at energy commodities or certain base industrial metals. There's certainly some inflationary pressures that are out there, and those things do price into the Treasury market in a pretty real-time way. But we're also looking at the possibility, as we just talked about, of higher taxes resulting from all the stimulus efforts. So in a higher tax environment, investors would be willing to, part ways with treasuries and would rather own a tax-exempt municipal bond because the tax-free coupon is more valuable to them in a higher tax environment. So the divergence that you see in the last several months between the 10-year Treasury yield and the 10-year MMD is really the outperformance of MMD, the outperformance of tax-exempt bonds relative to treasuries. And that outperformance is driven by, as we mentioned, positive fund flows, municipal supply that's been pretty manageable. Only recently has it started to outpace last year, and we talked about the reasons for that, and also expectations of additional stimulus and higher taxes ahead. The stimulus has been net positive for many different sectors in the municipal bond market, and the expectation of higher taxes is an expectation that favors tax-free coupons. And so those are the reasons why we've started to see that divergence that you're showing there on the chart.
Great point again. Now on this last chart, keep in mind, we started recording the MMU just after the pandemic hit the US, or at least we were all aware that it hit the US. And for years we had been thinking about it, and having an economic calendar seemed like something that was a must-have. But given that it's been so hard to compare year over year type data, I almost feel silly sometimes presenting this, because how much does it really matter? Aren't there so many other things that matter? But you are someone that's out there talking with investors. How important is this type of information to investors right now when they're considering purchasing municipal bonds?
And that's a very good question. I think this is the type of environment where you start to see investors across asset classes, not just in munis, look deeper and dig deeper into things like second and third tier economic indicators. Obviously, everybody's looking at inflation. Everybody's looking at the employment report that comes out monthly. Everybody's looking at anything that comes out of the Fed and the dot plots and the forecasts and summary of economic projections. But there's a lot more focus that some of these second and third tier economic, not that durable goods is, but some of the other numbers, getting a lot more focus than they might have historically. And I think you're also seeing, analysts in various markets dig into corporate earnings maybe a little bit more than they might have, because those things together, when you put them in the blender, give you a better sense holistically of the progress of the economy. And I think right now, the forward path of interest rates, or the expectation of that path of interest rates, is so heavily correlated to economic expectations and inflationary pressures that might result, that you are finding investors really looking at these numbers with more scrutiny than they may have in the past. So, it used to be easy to sort of focus on the big economic numbers and sort of dismiss the ones that were perhaps less relevant. But I think we live in a world right now where market participants are looking at all the economic data. looking at all the earnings and trying to really sort through that and get a handle for what that means for the economy going forward, and what that could mean for the path of rates as it impacts inflation.
Great, thank you. And on our last slide, we have the Fieldman Rolapp Associates Registered Municipal Advisors. I encourage anyone that wants more information to reach out to one of our team members. I want to take a moment to thank Glenn again. And I probably should have done this in the intro, is just say, Glenn is someone that when I want to know something about the municipal market, I reach out to him. Before I recorded the first MMU, he was the call I made the night before that. So I always value the time he takes with me to be able to help me prepare, and appreciate his insights today. So thank you very much, Glenn.
Thank you very much for having me. I've enjoyed chatting with you.